That was a lot. I mean, he tried to make it a nothing burger while nervously over explaining everything and highlighting the fact that the bank contagion is still widely an unknown. Rates were raised. I think that's the long and short of it. I don't think that the current Fed policy is achieving the goals that they want to achieve, obviously, or at the rate they're wanting to achieve them. JPOW just very unceremoniously declared that there will be no rate cuts this year, even though the market is pricing in three of them. I guess hoping that he folds to the contagion risk instead of addressing inflation. This is not bullish, but the bearishness of it may take time to be realized. I think markets are, stable right now and at least confident in their stability, right? In the trading range that we are in, say between 38 and 4200. I think the market is going to react very strongly to data after that speech, especially PCE, PPI, CPI. Just due to the Fed's overall uncertainty, we're probably likely to see volatility pick up in the SPX, equities especially over the next month. I think we'll see continued flight into the bond market, especially now that yields are even higher. Nvidia tapped, I don't know if anyone noticed, tapped just above Gamma Max before its failure there. SPX tapped the higher range of its call interest before failing. So both of them have blown the majority of their call side gamma off of the chain. Obviously, we saw a big capitulation on the call side there with that speech. Now we may see some put capitulation here in the bottom range, right? Especially on SPX. I closed my nearer downside puts right there. So I'm out of my March 31 straddle, both the 4010s and the 3990 3990 puts and the 4010 calls. Effect on GME? We still have T plus 2 to be realized. We had quite the pump yesterday, at least on the indexes, if not on GME itself. The carryover from that will probably be realized into the end of this week. I expect call positioning to start to break down over the next couple days. I don't think anything said there is going to breed a lot of confidence, and the market is going to, and this is just an initial assessment, but I would say that the market is going to pull back, not necessarily price wise, but liquidity wise. I think we're going to start to see more fear, more uncertainty, very much like mid to late December, where there was still a lot of uncertainty surrounding the Fed's last decision for the year. Well, I guess mid-December, and obviously more liquidity flowing into bonds. So, I think a slow breakdown over time in any bullishness here, and then violent and volatile reactions to incoming data points. And probably more data points than we've been looking at prior to this. I think reactions to CPI, PPI, PCE, those are going to be more pronounced. But also reactions to unemployment data are going to start because the Fed is really starting to push the labor narrative, and they need to. You can't have price stability without. They'll never achieve it without affecting the labor markets. And that, even if that means that they have to move the terminal rate up and increase rate hikes into the end of the year, they will achieve, if nothing else. I think more importantly than achieving 2% inflation, the Fed is targeting 4.7 to 5% unemployment, maybe higher. Generally, once unemployment starts moving that way, it starts to move that way very, very quickly. It's slow. It's slow to get off the ground, but once it gets some momentum, it can really take off. I mean, historically, if you look at unemployment rate increases in periods approaching recession, which we're definitely headed for, it's very slow, volatile data set, kind of just chopping a lot around a fixed point, and then it'll start to move, and then the momentum of that move increases exponentially until something is done to halt it. Usually, historically, or at least over the last 2 decades, in the form of QE that reinvigorates the labor market. If we hit a hard enough recession for a long enough period of time, that may come through government stimulus instead. But yeah, I think that's where we're at. Still a lot of positioning in this range. I think market's going to be mostly choppy into the end of the day. There's a little bit of positioning in the 40-50 range. I don't know if we'll see that high. We could. The collar's still in place. And then there's, puts closing out under 4,000 and at 4,000. So that can stimulate upside. But I think ultimately, over the rest of this week, we're going to see a breakdown in the longer dated call side positioning on SPX and futures. Also, futures are going to have to price in the Fed's determination to continue holding to the target rate once it's maintained and stop pricing in pullbacks into the end of the year. And that is going to have a probably more significant and dramatic effect on index pricing over the next 3 weeks or so. Was my speech better than Powell's? Yeah, it was.